This is a message for markets, for traders, investors, economists. Please explain to me why the recent GDP number isn't scaring you. Why is it that after growth has tanked to 5.4% in the second quarter of the fiscal year, most of you are still convinced that the RBI will continue to keep policy interest rates on hold in the December meeting? Is it because of high food inflation? Agreed, inflation this quarter is high, but it's because of 1 month, October, where vegetable prices spiked up and edible oil prices also rose because the government imposed import duties. You may say, oh, but that doesn't matter. RBI's job is to target headline inflation. So who cares? If it's caused by higher food prices, RBI has to keep interest rates high to prevent it from spilling onto core inflation. Array, but then have a look at core inflation. It is at multi-year lows. In fact, if you exclude vegetables, inflation is already in the 3 to 4% range. And mind you, despite the economy going through recurring food price shocks in the past years, core inflation has still been sliding down. So this fear of generalization of inflation from potato and onion prices to car and pressure cooker prices hasn't really played out. And for argument's sake, let's flip the issue. Suppose tomorrow food inflation is at minus 5%, but core inflation is at 7%. Then will you say, oh, headline inflation is low, we need to cut rates? No. You will say, have you gone crazy? Core inflation is so high, the economy is at risk of overheating. How can you talk of cutting interest rates? Who cares if food prices are low? So yes, RBI's mandate is targeting headline inflation, but that doesn't mean that it needs to ignore what's contributing to that inflation. Then some of you are saying, oh, how can the RBI cut interest rate when rupee is depreciating so much and it is firefighting with reserves to control that depreciation? Sure, great argument. So then can we at least drop this pretense that we care so much about inflation? Because you cannot simultaneously be an inflation targeting central bank and an exchange rate targeting central bank, especially when you have no control over capital flows. This is what is known as the impossible trinity in economics. If you keep interest rates high so that the rupee doesn't depreciate, then obviously it is no longer available to react to what's happening to domestic inflation and growth. Then all this headline inflation, core inflation debate is nonsense. Now, some of you might say, oh, but a weaker rupee means more expensive imports, so imported inflation could increase. Sure, but then riddle me this. Why is it that core goods inflation is still falling like there's gravity attached to it? And are you seriously going to keep a straight face and warn about imported inflation at a time when China is dumping its cheap imports in India and there are industries that are clamoring for the government to impose anti-dumping duties? So in all of this, I go back to my original question. Why are you not this worried about GDP growth sinking to less than 5.5%? India's trend growth is 6.5 to 7%. This is not normal. This is not just because of a random Shraddh happening in September or monsoons extending for an extra month. And if your argument is that, oh, this is because government is struggling to spend on capex after the election model code of conduct freeze, are you not worried that without the government spending, this is the state of country's growth? Yes, an interest rate cut won't solve the slowdown, but that is no reason to keep it high when there is so much economic fatigue. Monetary policy, after all, has to be forward-looking, because the impact of a rate cut today will probably be felt 6 to 9 months later. So the more you wait now, the further you risk deepening the crisis and the more you will have to cut later, regardless of where inflation is then. And for everyone who is getting so sentimental about exchange rates and think that the RBI should use interest rates to defend the currency, think of the foreign outflow that can happen if overly tight monetary and fiscal policies shake global confidence in the Indian growth story. So my question to you is this. If 5.4% GDP growth doesn't convince you to cut rates when underlying inflation is at its lowest level in years, what more are you waiting for? Another quarter of 5% handle growth? Below 5% growth? What will it take for you to be convinced that the time to act is now? For more such insights, like, share and subscribe to The Bond Economist.